Hello, and welcome to The Insight by Oaktree Capital. I'm Jennifer Marques, and I'm the head of strategy and structuring for Oaktree's asset-backed finance business. Today, we're going to be discussing Oaktree's recently published Performing Credit Quarterly, Who Are the Lenders Now? It's a pleasure to be joined here today by Armen Panossian, Oaktree's co-CEO and head of Performing Credit, and Brendan Beer, portfolio manager of Oaktree's asset-backed finance strategy. Armen, Brendan, thank you so much for joining me.
Thanks, Jen.
Thanks, Jen. Good to be here.
So, Armen, before we focus on our main topic of asset-backed finance, could you perhaps provide a quick overview of where we are in the credit markets right now? And for our listeners' benefit, I should note that we are recording this prior to the result of the US election and prior to the US Federal Reserve's meeting on the 6th and 7th of November.
Well, thanks, Jen. In terms of the markets as well as the economy, I would say things are looking reasonably strong in the economy, and they're looking even better than reasonably strong in the markets. There's been a lot of liquidity pumped into the markets through the years of stimulus that we had during COVID and a relatively benign economic and market environment since then. There were concerns around inflation. Those concerns appear to have moderated, but the capital that was deployed through stimulus into the economy following the pandemic has stayed in that economy and has accumulated into the hands of investors and savers. And those individuals, those corporate treasuries, insurance companies that may be originating annuities, and other types of investors are pretty actively looking at credit as a way to get a contractual return that is quite attractive today relative to 5 or 6 years ago. And therefore, against that backdrop of liquidity and demand for credit products, and combined with a relatively resilient economy, one where corporate performance, I would say, is reasonably strong. I wouldn't say it's anywhere near 2019 levels in terms of its strength or growth, but certainly better than what people thought it would be. The combination of the capital available to deploy and relatively benign performance in companies has resulted in a pretty meaningful tightening of spreads in credit across the board, both publicly traded credit, namely high-yield bonds and senior loans, but also in direct lending, specifically corporate direct lending, where the borrowers are owned by private equity firms or being bought by private equity firms. And we are seeing a pretty meaningful contraction in the spreads available in that particular part of the private credit market. And with that, I think we are seeing investors now looking for more complex parts of the private credit market to deploy capital into, where there is some additional return and there's some potential additional safety in the form of structural protections. So we're seeing that 2.0 evolution of investor appetite in private credit into the more complex areas where they could get as good or better a return than corporate direct lending, and with some additional either protections or diversification benefits.
And I think in that light, there's been a fair amount of excitement recently around asset-backed finance, or ABF for short. And I want to come on to talk about some of the secular trends that we believe may be driving that. But ABF as an asset class is not new. So to start, Brendan, perhaps we can take a step back and talk a little bit about the evolution of the ABF industry and how we've got to where we are today.
Sure, Jen. I think as I talk through asset-backed finance, it'll become clear that this isn't new at all. If you just zoom out, every time a bank or a non-bank specialty lender makes a new loan or a mortgage or a lease, they are creating or originating an asset. That's the first word in that asset-backed finance. So if origination is the business of extending credit or making a loan, asset-backed finance is the business of funding the loan, where the money comes from. In past decades, securitization has allowed for the creation of rated securities, which allowed insurers and other rating-sensitive investors to participate in asset finance. In addition to lending, banks themselves provide senior financing to other non-bank lenders. More recently, alternative investors have partnered with specialty lenders in customized private asset financing arrangements. What's new today is the changing role of banks. In response to a number of forces, and hopefully we'll get into these a little bit more, quantitative tightening, regulation, deposits becoming a little less reliable for all but the largest banks, and some headaches in their existing portfolios, the banks find themselves needing to shrink their footprint in the asset-backed finance market, which creates new and pretty interesting opportunities for non-bank capital providers.
So we're really talking about then a very established existing financing market. financing, if you like, the breadth of the global economy. But for those listeners that might be less familiar with private ABF as an asset type, Brendan, can you help us understand how we at Oaktree define private ABF?
Sure. And I'm going to try to describe this in a few ways from a few directions to orient the listener. So think of ABF as the private version of structured credit. Structured credit is ABS, CLOs, CMBS, RMBS. In direct lending, the collateral is corporate enterprise value. In real estate debt, the collateral is real estate value. Now, this is the leap. It might be a little disorienting. In private asset-backed finance, the collateral is pools of contractual cash flowing assets. Contractual cash flowing assets include loans, leases, mortgages, receivables, royalty agreements. Our assets are someone's liability, someone's obligation to pay. Now, we know that some managers refer to hard asset verticals within their asset-backed finance strategies, but hard assets don't represent an obligation to pay. So some contractual assets reference hard assets like an aircraft lease or a home mortgage, but some asset types, like a credit card receivable, are just backed by a promise to pay. Some asset types, like a royalty agreement, might reference intellectual property, which makes this even a little more interesting. But we're focused on pools, so not one, but pools of contractual assets of like type. We're not mixing together auto loans and solar leases in the same pool. So some of the key features that are attractive about asset-backed finance, some LPs today are a little frustrated with how slowly some of their funds are returning capital, particularly venture capital, private equity, private real estate, but also private debt strategies. Because ABF relies on the contractual cash flows, ABF investors are a little less reliant on a building being sold or a company being refinanced to get their capital back. Also, we can argue about whether aircraft leasing is attractive today. We can argue about subprime auto lending and whether that's prudent today. But what we can't argue about is if they're the same risk. They're clearly not. So you can build a diverse portfolio within ABF, and an ABF allocation should be pretty diversifying from your other private credit or real estate lending allocations. A couple of other attractive attributes of ABF worth mentioning. In corporate credit, you may have heard of Cov Light or liability management exercises, diluting recovery for lenders. Fortunately, ABF remains today a Cov-heavy market with pretty strong protections for lenders. And then lastly, ABF, when compared to other private credit strategies and private real estate lending strategies, ends up being a little bit shorter in duration and tenor than those strategies.
Armen, in the essay, we address some of the challenges banks have been facing and the compounding pressure that regulatory changes have placed on certain lending activities for banks. Do you think this is likely to be a short-term trend, though, or the start of a more secular shift in their lending activities? And if banks really are reducing their role in the ABF arena, who else is well placed to provide the essential capital here?
Well, if it was really only one reason that was causing the banks to withdraw from the market or step back from the market, I would say chances can be that it would be short term. But there are many reasons that the banks are stepping away. There's regulatory reasons. There's Basel III Endgame, which the US is in a comment period on, and we'll see some final rules in mid-2025. We've seen Basel III in Europe and have a sense for what it means for the banks, the punitive capital requirements that arise because of these types of investments for banks. There's quantitative tightening with the Fed just generally wanting to reduce its balance sheet. That results, generally speaking, in banks reducing their lending activities because their reserves could be reduced as part of the overall quantitative tightening that the Fed is engaging in. There has been sector-specific stress, including in real estate. Regional banks are exposed to real estate lending, and they're, for now, at least kicking the can down the road. But the size of their exposure relative to their equity capital remains very elevated. And therefore, their lending activities in areas like real estate and other types of assets where, for example, the specialty lenders, where they might also be overexposed, is the subject of much consideration and essentially a little bit of a freeze on lending. We saw some regional banking issues as well with the collapse of Silicon Valley Bank and a couple other banks following Silicon Valley Bank's fall. And that has also caused the risk managers and the regulators to look closely into how banks are using their balance sheets to earn fees and earn returns. And a lot of that mismatch in assets and liabilities, specifically deposit flight and how quickly nowadays with technology deposit flight could occur, is resulting in just a multifaceted approach to a more conservative banking environment in the US and globally. But certainly I think that the move in the US is most considerable over the last couple of years. Now, we expect all of these to continue, maybe not in lockstep, but certainly we don't think that any of them are going to materially reverse such that the banks will be expanding into asset-backed finance in any level that they were in, let's say, pre-COVID or pre-discussion of Basel III Endgame. But I think big picture also, just given the sheer size of the private credit market and given how large asset-backed finance is within that private credit market in the trillions, just given the breadth of the underlying industries that it services as lending, whether it's aircraft or rail cars or royalties of different types or consumer finance and auto finance, and even modest pullback from the banks, given the sheer size of that market, results in a huge lending opportunity for investment managers and other investors to step into that void. Insurers are going to be part of that solution. Insurers already participate in asset-backed finance. There are rating-sensitive investors for sure, but some portion of where the banks are stepping away could be serviced by insurers stepping in, and mainly an investment-grade deployment. If there is a senior lending opportunity where a bank cannot provide that capital anymore or quite with the same loan-to-value, but an insurer can, as long as it's rated appropriately, insurers can expand what they do in asset-backed finance. But I think the depth of the need for alternative capital is just too great for even insurers to really pick up that slack. And certain types of transactions won't be a fit for insurers anyway. Things where rating agencies will have a tough time of coming up with a rating will probably result in an insurer not being interested in stepping in, or it will probably create a situation where an originator of these underlying loans may not want to deal with that ratings process because of the handcuffs it would give them with respect to their deployment. So the big picture outcome here is that private alternative capital is starting to just emerge to fill this void because of the retrenchment of the banks. And it really reminds me, at least, of what direct lending felt like in the few years as we were emerging from the global financial crisis, the 2010 to 2013 timeframe, where clearly the banks had stepped away from certain types of lending they were doing in the corporate direct lending landscape, creating the need and the opportunity for direct lending to fill that void, especially in the middle market, but even expanding above the middle market. Private asset-backed finance feels much the same way, but I think it's even more exciting because of the range of opportunities globally, but also the range of collateral that is brought into asset-backed deals. Again, rail cars, life sciences royalties, music royalties, equipment finance, consumer. There's just such a huge range of collateral that could be brought into asset-backed finance that we are very excited about the private investment opportunity that is emerging as a result of this banking retrenchment.
Thanks, Armen. Yes, it does feel a little bit like we're in the position that we were a decade or so ago when the banks started to retrench from corporate direct lending. But as you say, perhaps with a far larger addressable market. And so, Brendan, as we look then across that investable ABF market, where do you think the most interesting opportunities lie right now?
Sure, Jen. And this follows on what Armen was saying. You have to remember the opportunity that's emerging for private investors is really driven by banks changing their posture, their footprint in the asset-backed finance markets. So as the banks retrench, the opportunities that are available, some of those absolutely can be filled in by insurers, and you don't have to look too far in the headlines to see alternative managers aligning with, buying, being bought by insurance companies to go after this opportunity. But we deal with a lot of players in the asset-backed finance market that for one reason or another, insurance solution is not the right solution for them. And insurance capital is highly regulated, and the insurers favor rated securitizations. And in Europe, it's not explicit ratings, but it's very similar. And some transactions, some capital holes, some business models, they just don't fit. And where we think it's most attractive is where the banks just left, where the insurers cannot step in, and where there isn't a prudent path to take that opportunity and turn it into something that fits a private equity fund, an opportunistic credit fund, a distressed fund, a special situations fund. So where the returns look like advertised private credit returns, but there isn't a path to rating or capital efficiency for an insurer, and there isn't a path to very high returns, very high multiple. And we find this to be pretty uncrowded right now and expanding.
So Brendan, within that space, can you give us a few examples of ABF investment types that you're particularly excited about at the moment?
Well, we like to wear a relative value lens. So we're always considering all the sectors with a focus on the ones that we know and have expertise in without getting wed to any particular sector. But I'll give you a sense of how we think about it. And I'm going to give you two sort of examples. One is where the fundamentals are very strong, and aviation finance. So right now in aviation finance, continuing from COVID, you have a reopening of the global commercial aviation markets, and we are through 2019 levels of demand for air travel, which is obviously a positive on the revenue side globally. Also, you have the two large OEMs, Boeing and Airbus, are just way behind in delivering aircraft. Boeing has been in the news, obviously. So you have strong demand for air travel, and you have limited supply. And this is really a fundamental tailwind for aircraft lease and aircraft lending, which are two ABF verticals. That's on the fundamental side. Now let's talk on the market dynamics or technical side. Home improvement loans. Home improvement loans can be loans made to homeowners to install energy efficient windows, maybe solar panels, maybe a new HVAC or water heater. And these loans, until recently, were commonly funded by or lent against by regional banks and credit unions. Those are two investor types that have recently found deposits as unreliable as a source of funding, and that's a new thing. And so home improvement loans are made to individuals, to consumers, to homeowners. And if you look at where we are today, we're at low unemployment. It's kind of hard to imagine unemployment going down 200 basis points, but it could go up 200 basis points. So you have a little bit of an asymmetry in terms of the credit performance going forward of consumers. But even with that said, the credit unions and regional banks have stepped back from being the financing provider for these kind of loans. That is a tailwind in the market dynamics that to us overwhelms and allows you to extract cushion against concerns you might have on the credit side. So I give you two examples, one where the fundamentals are very strong and we're very excited about that opportunity. Another where the fundamentals aren't necessarily strong. There's nothing to be concerned about right now, but the market setup is favorable. And we're always looking for those relative value indicators that can come in a variety of formats.
Thanks, Brendan. So for my next question, Armen, I'd like to zoom out a bit. We've talked about various attractive pockets of ABF, but big picture, how would you think about ABF as part of a private credit portfolio allocation and in comparison to direct lending, for example?
I think a lot of investors have enjoyed now for over a decade the stability of returns and income and pretty low defaults in corporate direct lending. I think that was the first large foray into private credit in a concerted way. And I think initially maybe the jury was out whether it will be quite as advertised in terms of it being stable and dependable income. But I think we're now more than a decade into the evolution of corporate direct lending following the global financial crisis. And I think a lot of investors have come away saying this is a very strong asset class with some illiquidity premium that gives them incremental return above the liquid credit markets, as well as stability in marking the book to fundamental performance. So it's been a good experience. But now, as investors say, well, how do I diversify my exposures? I do want to continue to deploy in this type of asset class, this type of stable, income generating, low default asset class. How do I do that? How do I do more of it, but diversify. And there really isn't a good way to diversify other than either regionally or by maybe certain sectors. If you go into a sector-specific fund, and perhaps that's insulated from GDP correlation and therefore correlation with the rest of the private credit or direct lending portfolio. But another way to diversify is in something like asset-backed finance, where you're attaching to a contractual cash flow stream, as Brendan mentioned, not the enterprise value of a particular borrower. So if you think about it, there's a value chain in the economy. A good is produced, there's costs associated with it, there's overhead expense to running that business. And if that business generates an adequate level of cash flows, then your loan to that business is worth more and more stable. It will recover your loan balance when the maturity happens. And hopefully in the meantime, it's been paying its interest as it comes due. But there certainly is a terminal value exposure in corporate direct lending that doesn't exist in asset-backed finance, because in asset-backed finance, you're attaching to a revenue stream in the case of royalties. You're attaching to particular assets that are critical to running your business, irrespective of your profitability in running that business. If you're an airline or if you are an aircraft lessor, you must own the aircraft. And therefore, the cash flow streams attached to those aircraft must be paid if you are in business. And that changes, as an investor lending into that space, it changes your attachment point as to where in the value chain your exposure resides. Is it on the revenue line? Is it higher up than the net, end of the day corporate cash flows? And we're not saying that corporate direct lending is a bad investment by any means. But for those investors that have enough exposure that they're looking at ways to diversify their exposure in uncorrelated ways, asset-backed finance gives you that opportunity to do it in scale and with underlying diversity, one investment to the next. Again, music royalties are very different than rail cars or subprime auto. That's really how investors should be thinking about this, as a diversifier against what has already been a very successful foray into private credit through corporate direct lending.
So Armen, I'd like to pick up on something you said there around the repayment profile of private ABF. Brendan, perhaps you could talk a little bit about the way that a lot of these private ABF transactions repay principal.
Right. We do get a question from our clients. Would you consider this more of a total return product or an income generating product? And because we're focused on these contractual assets, loans, leases, receivables, this is decidedly an income product.
Yeah, maybe I would add to that. It's different than corporate direct lending. In corporate direct lending, you get a coupon and you get maybe 1% amortization per year for 5, 6, 7 years until your maturity. There certainly are repayments and refinancings that occur well in advance of that maturity date. And so your cash flow return could be faster than the stated final maturity on the loan. But typically, and especially during periods of dislocation, a corporate direct loan has extension risk. It could be out 7 years and maybe even longer, to the extent that 7-year period hits an air pocket in the refinancing markets and you as a lender need to extend. But in the case of asset-backed finance, every payment that is received by investors has some component of income and some component of return of capital. And it's usually because the underlying asset has some element of depreciation associated with it. And therefore, the structures that we invest in oftentimes have cash flow returns in addition to income generation. And so the duration, in terms of just the contractual duration, is meaningfully shorter or within our control in asset-backed finance. And so that combination of income plus return of capital and the contractual nature of that combined payment gives you a better lens and potential in terms of repayment speed, but it also gives you the ability to express your sensitivities at that point in the market to certain types of duration. Like, do you not want to take extension risk at this point in the cycle? Do you want to actually shorten up your duration in your portfolio? Well, then originate shorter lived assets. That is all possible in asset-backed finance, and it's not really possible in corporate direct lending at this point in the maturity cycle of corporate direct lending versus asset-backed.
Thanks, Armen. Absolutely. And Brendan, you and I were saying the other day that it's actually a fundamentally different underwriting question that you are asking with ABF as compared to corporate direct lending. And that provides a natural diversification between the asset types. Brendan, can you perhaps elaborate a little more on how you think about that?
Sure, Jen. If you lend in corporate credit, the fundamental question you're asking is, will this company be worth meaningfully more than my loan amount when the loan is due? We study EBITDA adjustments, comps, we look at the leverage, but in the end, you want the business, the enterprise value to meaningfully exceed the amount you have lent to get repaid. In real estate, similar thing. Will the property be worth meaningfully more than I have lent when my loan comes due? So in real estate, in corporate credit, you are asking the fundamental question, what is it worth? What will it be worth? In asset-backed finance, it is a different question. The fundamental question is, will they pay? This is something that creates a barrier to entry, that this is the fundamental question to traditional debt investors coming from the corporate side or the real estate side trying to come into asset-backed finance. And this is a non-risk source of depressed competition, which we think drives additional return.
Yeah, we certainly like areas where we feel we can get overpaid for risk. So Brendan, how do you think about building a portfolio in private ABF?
Well, in a perfect world, I would just design a model portfolio with a little bit of senior lending against auto and some mezzanine lending against aircraft and maybe some buying loan pools on flow against mortgages. But that's not the way private asset-backed finance works. You can't make a portfolio and then start filling buckets. We are approached by borrowers, by originators, by sellers, by banks with capital needs. And we have to respond to those capital needs and apply our diligence, our relative value lens to understand if those fit our portfolio. So what we do is we have to respond to opportunities as they come in, and we have to consider our existing exposures. We have to consider the exposures that are likely coming in the future. So we want to leave room in particular for some of the potentially higher beta structures or sectors. And we want to have a variety of formats and underlying asset types. We have to think about how correlated are two different investments, even if they're not in the same sector. Do two investments have exposure to the US consumer? Do two investors have exposure to energy prices? So we're thinking about cross-asset correlations across our portfolio.
It sounds like in order to do that, then you really need quite a broad range of opportunities to consider. How do you approach sourcing?
Well, that's right. I think you do need to see a lot of opportunities in order to build this portfolio that's as diverse as you want it to be and has the characteristics that you want it to have. One of the things we focus on, and this is a business decision, is there are originators and the creators of assets. And there's something to be said for very formal partnerships with particular originators so that you have more certain access to collateral. We choose to go in a little bit different direction. We want to maintain the flexibility where we have a strong relationship without the obligation to continue to fund a particular originator. The danger is if you're really wearing a relative value hat, in the future at some point, it may be the case that whatever the sector is, railcar leasing or prime auto lending, that someday in the future, it's not a good idea to commit capital to that particular sector. But if you have overly prescriptive or formal relationships with individual originators, you can find yourself functionally stuck having to supply them with capital. And even in the case where the sector remains attractive, you may be discouraging other partners from bringing you opportunities. So we're trying to maintain flexibility, and it's important to take advantage of the breadth of your platform and all of the relationships that are available. And then the last thing that we have to consider is what is our market position, and really take advantage of the different kinds of calls and situations that might come to a place like Oaktree because of our special reputation and market position.
And we want the ability to be selective and, as you say, Brendan, take the right calls at the right time. So Armen, any final thoughts for our listeners?
I think the main takeaway for me, and listening to this conversation as well, kind of hammers it home, there's just so much within asset-backed finance. There's so many different underlying types of collateral, sectors, geographies, senior, junior expressions of risk and return in asset-backed finance that there isn't any singular way of prosecuting the investment opportunity. And that's, I think, what makes this the most exciting. It is an area where there's a level of inefficiency that is happening, unfolding before our eyes because of what we discussed in terms of bank retrenchment. But there's also not an accepted one-size-fits-all way of going about getting into asset-backed finance. Some investment managers will favor consumer lending because that's their background, and they like the statistical nature of a big pool of contractual cash flows. Others will focus on certain types of end markets where they built a business around. And yet others will say, I want to have a broad range, but I want to focus on end markets where I have an advantage in terms of either information or knowledge of management teams and a level of comfort around structure and underwriting of particular types of assets. And that inefficiency will help to drive alpha or outsized returns with risk under control. With that breadth of capabilities or breadth of investment opportunities combined with such different ways of going after that range of opportunities and the sheer size of the market, this is one of the most attractive investment areas I've seen in a very, very, very long time. And as a firm, we've been investing in asset-backed finance in our opportunistic credit group for many years. So we know a lot of end markets very, very well. We know what some of the pitfalls are. We know what to look for when the markets appear to be overheated in a particular area and attractive or full of what we would call bargains at other points in time. And with that history, looking more opportunistically at asset-backed finance through that particular lens, we are super excited to see a more regular way credit opportunity. And we look forward to discussing with our investors, with our origination partners, with our employees and other stakeholders in the evolution of asset-backed finance.
Thank you, Armen. And thank you both so much for joining me. It's been a really interesting conversation, and I hope everyone has enjoyed it as much as I have. Thank you to everyone for listening.
Notes and disclaimers. This recording and the information contained herein are for educational and informational purposes only, and do not constitute and should not be construed as an offer to sell or a solicitation of an offer to buy any securities or related financial instruments. Responses to any inquiry that may involve the rendering of personalized investment advice or affecting or attempting to affect transactions in securities will not be made absent compliance with applicable laws or regulations, including broker-dealer, investment advisor, or applicable agent or representative registration requirements, or applicable exemptions or exclusions therefrom. This recording, including the information contained herein, may not be copied, reproduced, republished, posted, transmitted, distributed, disseminated, or disclosed in whole or in part to any other person in any way without the prior written consent of Oaktree Capital Management LP, together with its affiliates, Oaktree. By accepting this document, you agree that you will comply with these restrictions and acknowledge that your compliance is a material inducement to Oaktree providing this document to you. This recording contains information and views as of the date indicated, and such information and views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed, that past investment performance is an indication of future results. Moreover, wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. Oaktree believes that such information is accurate and that the sources from which it has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. Moreover, independent third-party sources cited in these materials are not making any representations or warranties regarding any information attributed to them and shall have no liability in connection with the use of such information in these materials. Copyright 2024, Oaktree Capital Management LP.
Audiation.